In this lecture, which is a review of Chapter 17, we're going to consider specific final audit procedures. These are the audit procedures that we conduct before we actually conclude the audit and express an opinion of the financial statements. The first thing that we want to do as part of these final audit procedures is what we call a search for liabilities. A search for liabilities also includes considering contingent liabilities. A contingency such as pending litigation, possible claims, perhaps income tax disputes, are these items where it is probable that we're going to have to pay and the amount is reasonably estimable. As we remember from accounting, a contingent liability that meets this requirement must be reported as an expense and a liability. Well, these are liabilities that in fact at this point may not in fact require journal entries. So what we're looking for is we're looking for items or events that in fact should be reported as liabilities within the financial statements. So how are we going to do this? Well, we're going to read the minutes of board meetings. Perhaps these board meetings will have information that leads us to identifying contingencies. We're going to review contracts, agreements, leases, review tax returns, any communication coming from the IRS. We're going to confirm or otherwise document guarantees or letter of credits, as well as inspect documents or possible guarantees or other arrangements. And again, what we're looking for is we're looking for events that create liabilities that meet the standards of a contingent liability. Another piece of this is what we're looking for is we are identifying these contingencies through what we're calling legal letters. So these legal letters is a letter that's coming from the attorneys of the organization and identifying any specific events that in fact may lead us to conclude that a liability should in fact be reported. What we see here is in a legal liability, a legal letter this is a letter of audit inquiry sent to the entity's attorneys, and it's the primary means of obtaining or corroborating information about litigation, claims, and assessments. This is an example, and this is coming from the book. And essentially what you see here is this is a legal letter, and this is a letter that we are submitting to the attorney, to the primary attorney of the organization. And what we're looking for from this attorney is for he or she to identify any claims that in fact may lead us to believe that these claims should in fact be contingent liabilities. As we are conducting these final audit stages, these final audit procedures, we need to understand where we are in the course of the audit. And what we're looking at here are what we call subsequent events for the audit of the financial statements. What we're looking at here is we're looking at events that may impact the financial statements but occurred after the conclusion of the balance sheet date but before we've actually issued the audit opinion letter. These events can be classified in terms of either a Type 1 event or a Type 2 event. A Type 1 event is a condition that existed before the balance sheet date, perhaps an estimate, but within this subsequent event period. Again, the subsequent event period is from the end of the balance sheet date until the issuing of the financial statements and the audit opinion letter. But a Type 1 event is something where auditor has a conclusion to an estimate. So as an example, if at the balance sheet date we identified a contingent liability, let's say this contingent liability is for $1 million. So we set up the expense, we set up the liability. Within this subsequent period, the liability has been resolved. So let's say instead of it being $1 million, it was resolved at $5 million. And let's say the difference between 1 million and 5 million is material. The fact that we have a conclusion to this event that's based upon an estimate would require that we readjust the financial statements to this new amount, this correct amount, based upon the fact that it was a condition that existed prior to the balance sheet date. A Type 2 event is an event that occurs after the conclusion of the balance sheet date, before the issuing of the financial statements and the audit opinion letter, that do not affect the numbers, but may in fact affect the information from the perspective of a user of the financial statement. So these are conditions that do not exist at the balance sheet date. We may require a disclosure, possible pro forma financial statements based upon this new information. So let's say during this subsequent period that the company issues an additional 10 million shares of stock. Well, this has nothing to do with the balance sheet information as of the end of the year, but the information would be relevant from the perspective of earnings per share. And again, think about it from the perspective of the user of the financial statement interested in obtaining this information. So what we would do is we would disclose, and we would create some sort of pro forma that would show how these earnings per share will change based upon this new information, based upon the issuing of additional stock. We want to consider what exactly is the subsequent period and the opportunity that we call a dual dating question or a dual dating issue. What we see here is the financial statement date ended on December 31st, 2013. The audit report date, which essentially is the date when we conclude our testing and the auditors leave the organization. And then there's a gap in time between the audit report date, when we conclude the audit, and when we actually issue the financial statements. This whole period is what we call the subsequent event period. Now, what we're concerned with is this dual dating period, or potential dual dating period, that is between the conclusion of the audit, when the auditors leave the organization, to the issuing of the financial statements. What we see here, when this occurs, when an event occurs in this dual dating period, is we have two options, one of which is to dual date. So the dual date would be that the audit report would be identified as the date of the audit, and then we would say, except for item number 20 in the disclosures that's dated March 1st. What this does is it does a couple of things. It limits our liability, because it's all we're saying that happened after we left the organization and before the issuing of the financial statements is that something happened and this one particular item happened. We could, in fact, change the date of the audit report to include the subsequent period. It extends our liability, because what we're saying is that we are dating this as of the audit report date when we left the organization, as of March 1st, but we're not really sure if something else happened between that period when we concluded the audit and this identified subsequent item. The idea is that we could dual date, or we could change the date of the audit opinion letter. Subsequent events, and what we're looking at is we're looking at during this period of the subsequent period is we want to identify any subsequent events. So how are we going to do this? Well, the first thing that we're going to do is ask management what's actually happened. We want to read the interim financial statements. If you read the interim financial statements, let's say they're issuing a monthly report, and we see, hey, wait a minute, there's an additional $10 million in the bank. Chances are something actually took place. We want to read the minutes of the board meetings, inquire of legal counsel, and examine the books for original entries. Certainly we'd be looking for manual journal entries that occurred in the subsequent period, and we would be looking for things that are significant, and we would follow this up with inquiries of management. The final evidential evaluation process is as follows. We want to perform final analytical procedures. So we've talked about analytical procedures several times in our discussion. Analytical procedures help us understand where the areas are that have changed from the prior audit. We want to understand analytical procedures to understand how the organization fits from a competitive perspective as compared to other organizations in the same industry. And it helps us guide our audit and our focus in terms of areas of high risk. So the analytical procedures as a risk assessment tool is required at the beginning of the audit but you also notice that it's required at the end of the audit. And the reason that we're doing this is it's a one final check to make sure that things were not missed. So as an example, during the course of the audit, we may have had management change some of the values. Perhaps we identified material errors, and management agreed that these were errors and they changed the financial statement. In that case, it certainly would be absolutely critical that we look at the analytical procedures from the perspective of understanding if these analytical procedures point us to another direction. We want to obtain a representation letter. This representation letter is from management. The representation letter essentially is a letter that management is providing to the auditor that assumes all responsibility related to providing information to the auditor. It is one of the most important defenses that the auditor has in case something goes wrong in the audit after the audit has been completed. We clearly want to review the work papers, do a final evaluation of the audit results, evaluate the financial statement presentation and disclosure. You notice that we want to have an independent review of the engagement. What's very important is that within the audit group is an audit partner that has no direct knowledge of the day-to-day operations of the audit can come in, and he or she can review the audit work papers and draw the same conclusions that the auditor did who was actually working on the audit. The last piece is we want to evaluate the ability of the organization to continue as a going concern. Now we'll talk about going concern issues when we start talking about the audit report. But one of the critical things that we need to understand about the audit is that the audit is where we express an opinion of the fair presentation of the financial statement. However, our responsibility goes further than that. If in fact the auditor, as he or she is reviewing the financial information, comes to the conclusion that this organization is not going to survive for the next period, for the next 12 months, then what we would want to do is want to include in the audit report an assessment of what we call a going concern. As we are considering financial statement presentation and the financial statement stability, we want to identify anything that would suggest financial distress within the organization. Perhaps recurring losses, current year deficit, negative net worth. We want to consider some of these ratios, net worth to liabilities, working capital. All of these general ratios will help us come to the conclusion whether or not this is in fact a going concern, which is a definition of an organization as a going concern, or in fact if we have doubt that the organization is going to continue as a going concern in the subsequent period. As we're looking at this, it's very important that we understand what management's response to this is, and in fact they may have a plan to address the issues. If they have a plan, we need to understand this. In any event, our responsibility is to identify if in fact there's a going concern issue, and if there is, this is going to be a part of our audit opinion letter. Communication with those in charge of governance. One of the things that we've talked about is that the auditor is responsible to communicate to the audit committee several times during the course of the audit. One of the things that we want to communicate to the audit committee are things specifically related to the internal control structure within the organization. So we are going to report in a management report to the audit committee these specific recommendations that we have in terms of improving the internal control structure within the organization. Now the last point that we want to talk about is a subsequent discovery of facts existing at the date of the audit report. Now keep in mind that subsequent discovery is not the same as the subsequent period. Once we've issued the audit report, our responsibility is basically done unless there is what we call a subsequent discovery of facts existing at the date of the audit report. This basically is a very bad situation, and it's something that would imply that in fact there are fraud, maybe there is other issues related to the audit or to the financial statements that are significant. And again, fraud is probably the key issue that we would see here, which is why we want to have that management representation letter available and signed that basically shifts the responsibility back to management. But what we see here is that if in fact there is a subsequent discovery of facts that apply to the audit that we just completed, is what we need to do is to notify the entity that the audit report must no longer be associated with the financial statements, notify any regulatory agencies having jurisdiction over the entity, and then notify each person known to the auditor to be relying on these financial statements. Well, this is a very difficult task, and chances are what we would be doing is notifying the SEC so that they could get involved in terms of reporting this, so that those that are considering the financial statements will become aware of what's taking place. Subsequent discovery of facts existing at the date of the audit report is hopefully something that you'll never have to deal with, but if you do, it is a significant event that you need to take obviously very seriously. Okay, so we've covered a lot of material within this chapter. As we're working through this, we need to understand that right now we are completing the audit, we are tying up all the loose ends, and based upon all this information is we are going to issue an opinion of the financial statements. So I thank you very much for your time, and I look forward to talking to you.